Our next guest warns enthusiasm surrounding AI stocks is distracting investors from recession risks. Economist David Rosenberg is founder and president of Rosenberg Research. David, great to have you with us. It's certainly, when you look at this sector, it doesn't feel like we're talking about these companies living in an economy that is about to go into a recession, an economy that's about to hit hard times.
Right.
What do you think? I'm just curious. What do you think the Fed thinks about this sort of bubble-like action in a sector of the economy? Do you think it makes them think that their job is not done?
Well, I would say that there's no question. I think that we have a price bubble, and we had a price bubble with the dot-coms and the internet back in the late 1990s. But there's the financial bubble. But then there is, the real impact on the economy, and you could not argue that the internet was a game changer for productivity. So we had a real-time shift in productivity and what that meant for the corporate cost curve in general, and you had a financial bubble at the same time, and so they can coexist. I mean, if you look at the 6-month chart of the NASDAQ 100, you have to be blind not to see that, okay, this is actually looks very weird, and it's way overextended. But if I'm at the Fed, I'm looking at this as Paul Tudor Jones said, I think last week on Squawk Box, that this is a major productivity accelerator. And you're at the Fed, you're thinking, okay, this should actually help reduce the corporate cost curve and should be disinflationary. And so it actually, from a real economic sense, would work towards their anti-inflation objectives.
David, it's Tim. Thanks for joining us. When we look at what interest rates are doing and what people think the Fed, and having more conviction that the Fed has more conviction staying the course, it certainly adds to your thesis. And the thesis that, first of all, the cost of financing a lot of these corporates, their earnings profile are changing dramatically, and that rates are staying higher for longer. Talk about how you think that the Fed, or maybe you don't, but where the Fed is truly on their course here, but what that means for equities, especially when so much of the corporate earnings structure has been tied to zero rates for so long, and that equities aren't repricing that.
Well, it depends, which index you're looking at and which sectors you're looking at. So I don't think you can look at the stock market right now is some sort of homogeneous entity, okay? So if you added up the three most economic sensitive sectors of the market, you added up the banks, you added up consumer discretionary, and you added up the transports, okay? They have the highest torque to GDP. They're down more than 30% from the cycle highs. They're actually behaving in the exact same pattern they have going into the past 4 recessions. You look at the S&P 600 or the Russell 2000, they are still, even with the better tone this year, they are still in fundamental bear markets. So, look, when you have a situation where the S&P is basically now 27% technology, and technology is growth, which means it's a long duration asset that, yes, will look through the gyrations and around the business cycle. Doesn't mean they can't get hit, and we saw what happened back in the early 2000s. But by definition, growth stocks are going to react a little differently to the economic cycle than the pure cyclicals, and the cyclicals are giving you, just like the inverted yield curve is giving you, a recession signal.